First of all, it's no secret that interest rates are going up, have been going up, and will go up. So I think in Europe's, call it, 18 months behind where the U.S. is, but the Fed's been very clear about what their policies are. The 10-year's been kind of steadily climbing. I think it's more the case that we had the lowest volatility in history last year. And we had no 3% correction. We had a January that was what, 7%? I think January. The market's not going to be up 7% every month. And usually a very strong January typically is followed by a down February. And I think there's heightened political sensitivity.
I stole your stat. I think you probably heard that. But we're down 500. I mean, we can't minimize. We're not down 100 points, Bill. 500 is still a significant number. Apple now down 10% from its highs. A number of stocks are down 5 and 6%. People are going to wonder why. It can't just be history or natural selling. Don't you think there's some cause?
No. I just think it's the ebb and flow of the market. I think the fact that stocks, because the market's been so stable the last year and sort of steadily higher, people's sensitivity, I think, to decline is probably greater. So it feels worse than it is. But usually over the last 100 years, we've had several 5% drops in the market within 1 year, typically. So I think this is just trivial.
Yeah, and Charles, you've been in the business 50 years, okay? You've written 16 books. You've seen pretty much every kind of market cycle that we've had. But some would suggest that this time is different because you've got central banks with about $15 to $20 trillion in holdings. You've got interest rates which were artificially depressed for so many years. Is there any historical precedent to the kind of market we see today?
Certainly not. But in the detail, but in the general thing, that there's always terribly interesting things going on, very important trends being worked out, and really smart people paying attention, trying to figure out what does that mean for prices in individual securities. It's the same old, same old, same old.
Now, what's the most important thing going on right now, would you say, for the macro market globally? Is it rates? Is it central bank involvement? Is it investor euphoria?
As you ask the question, I have to tell you, I think the really most important thing going on is that retirement security is not being given the attention that it really needs because people are living longer than they ever did before, and they don't understand how much money it takes to be financially okay during their retirement. That's really important. Honestly, the sorts of questions that you'd like me to get into, I have to tell you, for me, they are details.
500 points is a significant move down, though, Bill, and I think that, I hear your point, Charles. Definitely people want to retire. Markets has been certainly very strong. Given valuations, given rates, given central bank involvement, is the market, in your mind, particularly fragile right now?
No, I don't think so. I think, again, when you're in these declines, if we go down 500 points for, 5 more days in a row, people get increasingly agitated. At the beginning of 2016, remember, the market down 15% in the first 6 weeks. And then it rallied significantly the rest of the year. And all of the stuff that it was worried about that took it down 15%, macro worries about Russia, about China, about the Fed tightening, all that proved to be just noise. And I think that right now, the most important thing that's going on in the market right now, I think, or in the world from a macro standpoint, is global synchronized recovery. And I think that's the first time we've seen that in many, many years. But earnings are going up, cash flows are going up, and I think the greatest risk that people face in markets is they fail to understand a very important thing, which is the economy almost always grows, and earnings almost always go up. We have recessions, and stocks go up most of the time. And so the risk to people's long-term financial health is being underinvested when in long bull markets, and not the drops that they get in bear markets. Even with the crash of '87, the financial crisis of 2008, if people just stayed the course, they'd be fine.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.